it's the stripper of insurance.
Oh no, where are you going with this?
You're not finding a long-term partner there. You know what I'm saying? I just want the plain, boring, old, I know it's going to work, a policy here. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Are you wanting to accelerate the rate at which you can stop needing banks in your life and have your own system? Would you like to overfund your cash value if you have an overfunded life insurance policy, but not sure how much you can put in and still keep your tax advantage? Or what if you have a policy that isn't designed correctly? What can you do to create better guarantees on your cash and keep flexibility? I've seen 90+% of life insurance policies are just not designed properly. They underperform and they end up costing you years of precious time and way too much commission rather than your own cash. Today is about how you design a policy to your advantage.
What up? Hey.
This is just like, what up? Stop.
What are you going to say? What joke?
What up,
what joke do you have?
I don't know. I just said, that's what came to my head is say, what up?
We're very formal around here, as people can tell.
Yep.
Okay. Todd wrote in today, and his question, like you said in your intro, is actually a really fantastic question. I think a lot of people will be able to relate to who are in his similar situation. But before we dive into that, the financial word of the day today is fiduciary.
Oh,
Say
nice.
that 5 times fast.
Yeah. Fiduciary, 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 fiduciary.
Oh,
There you go.
you did much better than I thought.
Yeah.
Much better than I would if I did that. So a fiduciary, and I want you to add to this because you have a lot of thoughts on this, but essentially a fiduciary is a person or an organization that acts in the best interest of another party.
Right.
Okay. So how does that apply to the
fiduciary responsibility, right?
Yes.
So what if the best thing for you didn't have to do with getting them commission? They should be acting as a fiduciary in your best interest. Mm-hmm. I saw this for the first time when I was 22 years old and I saw a family office, which showed like this comprehensive financial team working on the behalf of a client, doing real due diligence and analyzing everything. And they were just paid to be part of that, not paid for the transactions. Yeah. But they also were looking to advance that client's interest. So there have been new rules that have come out with fiduciary responsibility for financial advisors. Mm-hmm. And I think that there's a lot of progress in that, but there's still some problems in that.
Some work to be done.
Yeah, there's work to be done because how do you determine what's the fiduciary responsibility and how much did Wall Street and the institutions determine what that is versus like what was really right for the client? Because I'm still seeing far too many clients without enough cash on hand, without enough liquidity, still using the only primary investment vehicle as the stock market, even though they're business owners. So it's progress, not perfection, So
does every financial advisor have a fiduciary responsibility?
It depends on what they mean by financial advisor. You definitely, when you have certain licenses, like a Series 65, have a fiduciary responsibility, but there's still interpretation of what if you're just a life insurance salesman. So yes, there are now fiduciary things that are spilling over there, which is great, but it's still relatively new that they've upped the game here. And so I think it's yet to be determined of how much more needs to be done versus doesn't. The only issue I have with the way that it goes is like sometimes people rely so much on advisors, and the more that they feel like they have a fiduciary responsibility, the more they think they don't have to think as a customer. But I feel like to delegate your finances completely is reckless, just like you can't delegate your health completely.
Yeah, I know.
People can't work out for you, right? People can't eat right for you. Now you can hire someone for your food. You can hire trainers. You can do it more efficiently, but it should be looked at as a partnership, not as just tell me what to do.
Right.
Because that's where I think far too many people have gotten into trouble.
They put too much trust in another person. Yeah. Well, not too much trust, but they've just negated their own responsibility.
Like to me,
influence.
I think retirement plans are relatively reckless for people that have loans that need to be paid off first, that don't have enough liquidity, that have undercapitalized their business and have been living a very chintzy, miserly life, yet they're not going to have a problem. The fiduciary thing is like, well, it was a low cost 401k versus a high cost 401k,
Yeah, so the person that you have in your life that's
so it doesn't mean they're good
you,
strategists.
Right. I was going to say, if they're not looking at your personal situation and the whole picture of your life.
Yeah. It's a step in the right direction, but it's still limited within its scope. Like it's not what you see with the family office. I'll tell you that much.
Yeah. Very different from, I mean, I've never experienced a family office, but just from your stories, it sounds very different. Okay. So Todd's question, he said, I read your book, What Would Billionaires Do? And I loved it. I have begun putting pieces into place, beginning with whole life insurance. My dad was a State Farm insurance agent for about 19 years, and I have 8 policies, one of which is a UL, a universal life, which I plan to convert to whole life. During all this Corona craziness, I have cashed out my IRA and plan on doing so with my Roth and my wife's Roth as well. I went to deposit those funds into my whole life policies for cash value, which they then said the only way we could do so is if we pay forward the premium, which is not what they said previously, which would only add some to the cash value. However, I can add all of the funds to my universal life policy. So here's my question. Should I add the proceeds from my IRA and Roth to my universal life policy cash value and then convert it to whole life?
I think that right now it sounds like a lot of limitations based upon the company, not based upon the product, if that makes sense.
Okay.
Like, because normally what you want to look at is a PUA right, or paid up additions, which allows you to overfund, allows you to add more cash. But some, maybe because you didn't have it when you first got the policy, maybe their policy is they don't let you add it later. Other companies, you just have to maybe get a normal test that you'd get with blood and urine. If you're starting a policy, some let you have a lot of flexibility. You pay a minimum of $100 a year, but you could always add more. So I would really look for a company where you have flexibility with the paid up additions, and that you could actually do something called a 1035. A 1035 allows you to roll your existing policy over if there's gains. So if you've got more gain than what you put in, if you cash it out, it would be taxable. But a 1035 allows you to roll that to another policy, whether that's a whole life. It doesn't matter if it was a universal life first or variable universal life or anything that had cash value. You can roll it to a whole life that could be overfunded. And that would prevent any tax on that rollover. So 1035 would be one thing to consider. The other thing that you are going to have limitations on is known as the MEC limits, MEC, Modified Endowment Contract. Basically, when the universal life policies got created in the late 70s, early 80s, it was kind of like this place where people could just dump tons of cash in and then not have to pay tax when there's really high interest rates. And so the government came in and said, hey, we've got to create some corridor here or some limits that you can't just put everything in there without tax consequence. It really needs to have a benefit that when you die, you're not a burden onto the government or something, right? Whatever they justify to give that death benefit. Well, so you have modified endowment contract limits that you want to only go up to those, not above, because then you can make it more of a tax deferred vehicle and minimize some of your tax advantages. So there's that factor. So 1035, paid up additions, the MEC limit, and then maybe you just have to move it over time, because I think it's important to have at least 3 months of your 6 months liquidity that I recommend inside of, cash in a safe, cash in a bank, and not all in your cash value, because cash value has provisions that, one, if you need the money tomorrow, you're not going to get the money tomorrow from your cash value. I think the fastest you're likely to get it would be 72 hours. And if you're not wiring back to the place where you're paying premiums or you're having them overnight checks, there's processing time.
Right.
And there's paperwork involved. Sometimes if it's under like a certain amount of money, it's just a phone call and verification. When it's over that, it's a little bit of paperwork, and it just could take some time to go back and forth. When I was buying this very place that we're sitting in right now, I was going to I was going basically to Burning Man, and on the way there, I'm closing on this property, and I have 9 days, and then that Monday's Labor Day. And then we had an issue with UPS. There was a storm on the East Coast, so it didn't come. And then when it did get here, there was a mechanical issue. They didn't move things off the plane. So it took me like 9 days to get my money because of holidays and because of, issues in that.
Unpredictable
Less issues when it's just from a bank. But there's a provision inside of insurance policies that says they can take up to 6 months to give you your cash.
6 months?
Yeah, now every company I have a policy with, AUL, Mass Mutual, Guardian, Penn Mutual, like none of them have ever had that triggered. But the fact that it's in a contract, I think we need to prepare for it, because if there's some crazy chaos going on in the economy or whatever it is. So that's why I like to have a little bit of cash kind of somewhere else. And then you could always filter that cash into the cash value from year to year. And if you pay annual, it's a little bit cheaper than by paying monthly. So that's one consideration. And then you wait till that next year and you've got 1035 provisions. But I'm not a huge fan of UL. I interviewed Todd Langford that wrote Truth Concepts Software on the 10 major issues with UL that most people aren't aware of. It's built on a term chassis. It's about 20% more expensive than term insurance. The cost of insurance can go up over time. You know, there's a lot of factors in that. So I do have one universal life policy, but I'm using it specifically as a death benefit, not as cash value and death benefit, because they can change the cost of insurance over time.
Yeah.
Because I can lose certain guarantees if I didn't make one single payment. Like that's like the seductive, you know, it's the stripper of insurance.
Oh no, where are you going with this?
You're not finding a long-term partner there. You know what I'm saying? You know, I just want the plain, boring, I know it's going to work, you know, a policy here. So I just wanted to see if I could make you laugh with that. And I definitely did. Yeah. So anyway, you know, I would be really careful with using that and then converting it over. I would just like to set it up right from the beginning, look at a 1035. It depends. There are some really good cash value universal life policies that serve their purpose, but some have surrender charges. So it limits how long you have to, you know, it limits how quickly you can move it and you have to stay in it longer. So that's one of my major issues with that. And I just think it's the company. So I think there's quite a bit we've said here. And Billionaire's Method is, you know, you really mentioned the book, What Would Billionaires Do, and really enjoyed it. It's got some great resources, but if you also go to cashflowbanking.com, they can analyze, they can look, they're not like beholden to one company. You know, there's maybe 24 companies that I would feel comfortable having a policy with. And so they can represent those companies. They can look at what's best for your situation. And, you know, in this PUA overfunding type of situation. So that's who I use. You know, I don't own the company. In disclosure, I create content for them all the time, you know, and they're one of the licensees with my intellectual property. So there's definitely a relationship there, you know, and I have influence over certification of the people. So but it's not like it's something I'm dealing with every day or every week for that matter, right?
Definitely.
So, any other questions you've got?
Well, I'm just wondering, you know, for Todd, like if his current whole life policy doesn't have the PUA rider, he could simply just open up another policy,
possibly
pay the fee.
If his health is good and all that kind of stuff, and he can roll those over. Okay. You know, but it sounds like it's probably with State Farm, and maybe State Farm has limitations. State Farm is a place I would feel very comfortable owning car and homeowners insurance, but I would not feel comfortable owning life insurance with.
Okay. So Todd, you may want to look into some of these other companies Garrett mentioned.
Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.